So we've got a few questions to ask. What is President Buhari's debt managers' strategies? What are they achieving? And how can you trade and invest in the new domestic debt market direction? And how much is left to be done? And that's the conversation we're having now with Robert Omotunde, who is the head of research at AfriInvest. And just a little bit, a PR there for AfriInvest. That's the first investment firm in Nigeria to roll out a debt portfolio or mutual funds 21 years ago, 1997. That's about, 96, 97. That's when you had the NIDF, Nigeria Investment Debt Fund. That was the first dollar-denominated debt fund in the Nigerian market, priced in dollars, listed on the Nigerian Stock Exchange, tied to the 30-year U.S. Brady bonds. And I remembered all that just like yesterday. So let's talk to Robert here. This is the man who knows about the debt market in-house. Good morning.
Thank you, Bossing.
You're going to pay for that PR.
Yeah.
Just in case I get a debit note, I'm going to push that to you. So just add that to your end of year, your giveaway.
I'll buy Pluto's fund for you. Yes. To pay you for that PR.
With the yields going down, I'm not too sure I want that. I would have taking that from you when rates were 20%. Now you're offering me when rates are going down to 8%. But it's still a good one to have you here. Yeah. Welcome back from this is a report. Look at this Bloomberg report, and that's what this morning, when Nigeria was ranked among the best performing global emerging markets in 2017, taking our slot alongside South Africa. It's been a very nice year overall.
True.
On both sides of the street.
True. Of course, this is not surprising. You know, in the financial markets, policy is everything. You know, when you have the right policies, you know, investors always want to invest. You know, and what we've seen in 2017 was Nigeria moving in the direction of the right policy that we ought to have. And this turnaround came when we launched the investors and exporters window. You know, it has been phenomenal for the financial market, especially the launch of that window. You know, you would notice that was when we saw the liberalization of the foreign exchange market. You know, even though you still have multiple rates in the system, you know, that will change over time. But I mean, the launch of that window single-handedly has led to the 46% that we've seen in equities market year to date. You know, it has also accounted for the much of activity we are seeing even in the fixed income space.
Okay.
Yep.
Just about 3 months ago, let's get to business. The President Buhari's debt managers are led by the Ministry of Finance, and of course in bed with the DMO and the central bank unveiled a new debt strategy. Of course, this was expected because it looks like they're getting hanged by the day looking at the size of the local debt and the plans they have to borrow globally. So they had to rebalance the portfolio. So there's a strategy that they've come up with. Do you think we are seeing implementation of that strategy that was announced by Kemi Adeosun?
Yes, indeed. Remember that they came out to tell us that they want to structure the debt portfolio of government such that they have 40% of foreign denominated debt and, of course, 60% of local. There's a skew currently because the local debt, you know, has always been like 70% of the portfolio, you know. And what their own clear strategy for doing that was to say they were going to approach the international debt market. Remember, when we went to the international debt market, the Eurobond market to be specific, in February, you know, we saw how a lot of fund managers were hungry for Nigerian instrument, not just Nigerian instrument, emerging market instrument because of the high yield, you know. And the rate of success that recorded also informed the new issued, which we saw in November, where the federal government issued a 30-year instrument, you know, at 17.6%, and another 10-year instrument, I think about 16.5% coupon. I mean, 6.5% coupon, you know. And what they are targeting at doing, even though they raised about $3 billion, you know, as at the last time they went to market in two tranches, they are looking at refinancing the short-term debt, domestic debt, to the tune of about $500 million, you know, and that technically should account for what you're seeing right now, the news flow that the Debt Management Office is not willing to do a rollover of what we would normally see. Typically, what you will see is they come to the market on a maturing Treasury bills date, and they roll over the same amount. So it's been a way of refinancing, those debts. As far as I know, this has been on for more than 3 years, and this is a change in strategy.
So they want to close down on this?
Well,
write it off, pay it off.
Exactly. So in this particular time in December, they are not rolling over the maturing bills, which has been summed up to, for this week, we have about 146 billion maturing in Treasury bills. Next week, we're going to have another 50 billion worth of Treasury bills maturing. And these are instruments that the DMO wants to pay down without rolling over. Whether this is optimal, in terms of the cost of financing, will be a different conversation in itself, because when you match a long-term refinancing option for a short-term debt, then you now begin to see, you may not be able to analyze how impactful that will be, until you see what the interest rate, future interest rate will look like.
For that, the long-dated window, which you're taking up in dollars moving forward.
Correct.
So you have a number of external issues to deal with tomorrow and the day after.
Exactly.
Very interesting today.
Some exchange rate issues to worry about. These are foreign.
The currency risk to that as well. And interest rate risk as well. As we look at the U.S. Fed, most likely today, some folks say Janet Yellen may just raise interest rate.
The rate is going up
even if that's going to be a goodbye move from her before the new Fed chief comes in office sometime next year. But again, luckily, it's always been a matter of rebalancing, and folks have always knocked the central bank, knocked the government, knocked the banks from profiting from using government money to buy government papers and cream off a decent return on it. Those days are getting over, yes or no?
Well, it's a point of looking at what the government is trying to do at this time. Remember that in the fixed income market or any other market whatsoever, fundamentals always drive the market. And in a typical market, you will have the buyers and the sellers. Historically, the federal government and the central bank have been the largest supplier in the fixed income market. At the Treasury bill hands, the short-term hand, the central bank, supplies the Treasury bill. They also supplied OMO for their monetary policy management. At the long-term end, the DMO, we always issue, short-term and medium-term bonds, for the financing of government budget.